Thanks everyone for tuning in today. As we saw from the title, we're talking about managing through the interest rate volatility of 2023. And what a difference 9 months later makes as we sit here in early October, where there was ebullience in the market during the first few weeks of January. We've had a lot of whipsaw behavior. We got the sell-off back in rates in February. We had kind of the banking scare in March. We had this kind of grind sideways for a little bit in yields, and then we've had this resurgence in yields once again over the last 6 to 8 weeks. And so it's been there's been really no reprieve within the bond market to date. But the good news is it's starting to look like we're getting towards the end of the hiking cycle. It's looking like even with this new repricing out there, that there seems to be some value in fixed income. And so markets are always humbling. They always remind you that things can last a lot longer than you think. And they tend to go against the consensus, which all of a sudden we're seeing massive capitulation in the bond market, where almost every single Wall Street strategist out there is trying to one-up each other about how high rates are going to go after missing this for most of the year. So let's talk about where we are in the macroeconomic environment right now. Let's talk about what that means for fixed income markets, what it has done. Let's look at some of the opportunity set going forward and how the portfolios are positioned, and a couple different ideas for trying to execute in this challenging market, which we all hear the mantra from the Fed that they're going to be higher for longer. So I'm going to focus a little bit on the shorter duration side of the equation to start the discussion on the portfolios, because there are some very interesting opportunity sets there. There's pros and cons for using that versus a traditional bond portfolio. So without further ado, let's jump into the macro. And what I wanted to start off with was the policy rates here that we've seen across the globe. And the U.S. is not operating in a vacuum. And you can see this over the last 2 decades or so, that effectively the entire developed world tends to really behave in a similar fashion. Now, there is that one aberration. You can't really see it. It's in a dark brown color there. That's Japan. But essentially, they just keep their rates between, I guess it's between minus 10 basis points and a whopping plus 25 or so. But effectively, what you see here is that this is a coordinated cycle. It's because, again, we tend to consume a lot of the same things. We tend to run coordinated policies because of the currency moves as well. But no one's really been sparred in this environment. Yes, some rates are higher than others, but ultimately what you've seen is really a repricing around the globe. And so it's not just the U.S. bond market. It's actually been worse outside the U.S. because, again, starting with lower yields, in some cases negative yields in those markets. And then, again, if as a dollar investor, the currency adjustment. But to kind of zoom in on this too, so the last slide showed what has happened. This is zoomed in really over the last 2 years, but also throws in the forecast that's implied from various parts, from financial markets. And so you can see here that even though there wasn't a lot of the punditry saying meaningfully higher rates in 2023 from where we started the year, what you have seen is that expectations are that we're really nearing the end of this cycle. So the one area that has a little bit of a hike still priced in is the Bank of England. You're looking at the Fed today too. If you think about this, actually, I want to say it was about 2 months ago that the BOE was actually projected to go above the Fed funds rate. You can see here there's kind of some optionality in the pricing out there. Again, this looks at the futures market to determine what's going on. But you can see that the market is pretty much saying that we're nearing the end of this hiking regime, and that goes really across the board for all the developed central banks. Moving on to the economic data. So one thing that's been the aberration is the surprise that we've seen across the market. So if you rewind the clock to the beginning of the year, the consensus was there's going to be this Chinese reopening story, that the Chinese were going to follow a similar path that the developed world did when coming out of lockdown, massive travel, big consumption, big boom to the economy, and that was built into the expectations. The other idea that was baked into expectation at the end of the year, U.S. is going to kind of muddle along, potentially a recession towards the beginning or late first half of the year, potentially early second half of the year. And both of those things couldn't be farther from the truth. In fact, I'll talk about the U.S. As we go through this a little bit more. but how strong the U.S. has been backward looking. If you're able to hear some of my comments from my Bloomberg interview last week, it's one they were talking about is that, yes, that is what has happened, but it's very dangerous to extrapolate the current experience and assume that goes on indefinitely. Same thing with China. You can see here, Chinese market's disappointed. We've all read about the high headlines and the challenges that they have within there, but also the Eurozone is disappointed as well. So this U.S. exceptionalism is a phrase that was thrown around during, post GFC, pre-pandemic, and you're starting to see a little bit of that right now. But again, this is just relative to expectations, and so this is why we've seen some of that stronger economic activity this year. Looking at the manufacturing side, so this is a heat map looking at the production and manufacturing indices. And again, it's a wall of numbers here, so we color code this. Apologies to those that can't see the difference between red and green. But what you see here is that there's been a serious deterioration in the manufacturing sectors globally. Very few places are actually having an expansionary environment according to these surveys, and the bulk of the developed world is extremely red. Look at Germany there is one of the worst readings we've seen there, and some of the data that we're seeing out of Germany rivals what they were showing early in the pandemic as well. So manufacturing is definitely deteriorated. The U.S. did have a nice uptick. I'll talk about that in a little bit. But again, there seems to be this kind of global manufacturing slowdown, and that's, remember, we had the supply chain issues. We had to have a significant resurgence coming out of the pandemic, and so as one of our macro analysts or our team members likes to say, well, a lot of this data has to normalize back to the downside to net all of this out. And looking at GDP. I'm still using this back to 2010 because what I like to show is how tight the range is for GDP. It vacillates between like a 1.8 and, in a good year, you get like a 2.9% growth rate. But in general, that the center of gravity was about 2.3%. We seem to be drifting back towards those regions. Now, we obviously had the dip down in 2020. We all know what happened there, a significant rebound after massive stimulus and trying to get the economy back together. But notice here, even looking at what we had in 2022 and now the estimates for 2023, again, it's still early for those to get finalized and converge to actual GDP, we have about 2.1%. So this is back to the trend line where we were before. Although remember, expectations were that the U.S. would probably slip into a recession sometime this year. You can kind of see some of this as well as 2024's estimates are grinding down. Look at that green line and how it's been revised downward. Some of that is just the pull forward of what we've seen in 2023. Notice that that purple line was dipping down. That got pulled forward, and so now the expectation are we're gonna ultimately have to have a slower growth rate in 2024. So there is a setup for some of this out there. There are some headwinds. Some of those I was identifying in that Bloomberg interview. Apologies that couldn't hear it very clearly because of some of the music over it. But in general, what we're looking at here is the setup we see, and I'll go through some of these charts on why some of this is starting to look like we're getting later parts of the cycle. Again, later does not mean recession. Slowdown or decelerating growth does not mean recession, but some of that exceptionalism that we've seen is indeed potentially behind us. Here's another way of looking at this. This is post-World War II, U.S. real GDP. So it shows the GDP growth rate. Because it's such a long time series on a logarithmic scale, that's why the scale looks weird like that. But what it allows you to do is compare growth rates. And notice our trend line back to the financial crisis. So we were on this kind of upward sloping trajectory. Something happened during the GFC where it hit our potential growth rate. Some of that was probably because we let bad businesses go on. Again, we were mired in this significant, what was looking like a global depression. So we cut rates to zero. It slowed down the growth rate, right? Look at the slope of that line. Something changed at the GFC. And with all the talk about this U.S. exceptionalism and everything that's going on, notice what we've done. We are back on the post-GFC pre-pandemic trend. Nothing has really changed. Yes, there's been a dip down. There was a recovery since then, but we seem to be back on this trajectory here. And again, some of this is CBO estimates. I'm sorry, this is the IMF estimate. Sorry about that. When thinking about overall growth rates. And so for all this shock and awe that happens, supply shocks, trying to get back to some normalcy in the marketplace, essentially all we've done is be able to plug the gap. And I'll show how we've done that as I get later in the slides. But we talk about interest rates, you talk about how it's supposed to put pressure on the overall markets, but notice here, looking at something called the financial condition indices. And so Bloomberg puts one out, there's a few investment banks put these out as well, but it's just trying to talk about, well, is policy being accommodative or is it tighter? And they use a bunch of components. What's nice about Bloomberg, we can look through all the data. You can see the components up top of what's driving this. But notice here that essentially this says that right now, if you look at what's going on in financial markets, remember, a lot of these are financial capital markets driven ideas, but it's the cost of financing in the marketplace, looking at spread levels. And essentially what you find is that they're pretty accommodative in the marketplace. So as stringent and tight as the Fed has tried to be, or that the Fed has been to date, it's being offset by some of these other areas. And some of that is due to, as I mentioned, we've had a strong consumer over the first 9 months of the year. We've seen inflation be disinflationary and coming down. So a lot of these things have led into more accommodative conditions in the marketplace versus even what the Fed is trying to achieve by being tighter as well. So you can see in there the one of the few things is kind of the MOVE index. I'll talk about that before we're done here. But aren't a lot of things that are detracting from this more accommodative environment from there. And so another way of looking at GDP, since we only get it infrequently, I know people are up in arms about the Atlanta Fed GDP now estimate for the third quarter, which is still hovering above 5%. If you look at one of the competing models from the New York Fed, it says kind of in the low 2%. I don't know. I think the truth's probably somewhere in the middle. But another way of looking at this is something called the Fed Weekly Economic Index. And so this is an amalgamation of a bunch of economic statistics. They come out to try to help forecast GDP as well. And what you see here is that the relationship between the economic index and the GDP, it's not great. Again, it's a little more high frequency, but it tends to get some of the directionality correct when looking at where we're going. And what it's saying right now today is that GDP probably is somewhere in the kind of low 2% range. Strangely in line with where economic forecasts are, kind of in line with where that overall long-term trend has been in growth rate since the global financial crisis. And so again, these are good things that the economy has been growing. But remember, when we look at data like this is not a forward-looking indicator. This is a backward-looking indicator. It tells you what has indeed happened, not what is going to happen. And so some of the more kind of contemporaneous to slightly forward-looking indicators are things like manufacturing and well as services. I showed you what the global manufacturing picture looks like. The ISM puts out data on both manufacturing as well as the services. And we know that services makes up the bulk of the U.S. economy as well. This includes things like leisure, dining out. It also includes your home as well. And you can see here that the services data has indeed bounced up and is looking somewhat expansionary as well. So what you find if you look at this manufacturing, we've been mired in a manufacturing recession for the last year plus here in the U.S. If you go back and look at this, so you can see the entire developed world has been as well, or at least in maybe it's not a manufacturing recession, but it's a manufacturing contraction. However, it's the service side of the equation that's held up. And if you look back at this chart, and at least over the last 3 recessions, it's not that you just have to have this contraction in manufacturing, you also have to have it simultaneously with the services component. And so, again, we've seen some of the CHIPS Act helping, the IRA, the Inflation Reduction Act is helping put some more investment on the manufacturing side. But this is the resilience that you see in the service sector. And so remember, this is also measuring, the latest measurement is through peak holiday travel as well. So we tend to get these boosts in the service data when you look at the seasonal component of it as well. And one thing that alarmed me about the March banking issue was that I was really afraid post SVB and some of the activity saw and some of the scare we saw in the banking sector that this was going to really put a contraction on small business credit. And so one way of thinking about this, NFIB puts out a survey. The optimism came out today. It's a little bit under expectations, but I don't really glean much from today's report as well. But what you find in this too is that if you look at that orange line, this is how many respondents are saying that they have tighter lending standards for loans. So tighter is not easier to get a loan. They're making it more difficult to get loans. So you can see there that this level, this orange line, seems to be consistent with the last 4 recessions. Now, again, 4 is not a huge sample size, but usually when you get a meaningful contraction on how many entities are actually contracting, it gets to a pretty, once you get about half of them reporting that, it's usually signs that potentially there's a recession at some point in the near term. Now, the other thing is that blue line, the blue line, what it's trying to do now is telling you, okay, the availability of a loan. So when that number is going down, fewer loans are available as well. So tightening conditions just talk about harder to acquire the loan. Also, from the standpoint of actually interest service, documentation, higher rates. Those are things about tightening standards. But that availability of loan is, are you willing to make them? And what we've seen recently is there's been an uptick in the ability to make them as well. And so, or there's fewer on the downtick, as I should say, as that series tends to be pretty much negative in most scenarios. But we was getting scary there for the last few months. We kind of got out of an area that doesn't look as consistent with the negative side. But seeing that orange line continue to deteriorate does cause us some concern. Why do I point this out? We talk about small business, medium enterprise being the backbone of the economy. We also talk about the job creation. Most of this job creation in the last 18 to 24 months occurred at this level of enterprise. And so what you see here is that if this is such a dependent part of our overall economy, and these people are having harder access to capital, it is problematic. So what I showed you in those financial conditions and talking about the easing of conditions, because corporate spreads are some level, high yield spreads, muni spreads, that's great if you have access to capital markets. But if you're a small business and you need access to money, you borrow at something called the prime rate. Well, for those of you not familiar, prime is 300 basis points over SOFR. So typically that is the best rate there is out there, and banks offer a spread above that if you want to acquire a loan. Well, today's rate, a prime rate, is 8.5% after this Fed policy. So if you have a revolver or you're looking to generate or create a new loan out there, originate a new loan, these are the market rates that you're paying today. This has to have some impact of the slowdown. So I know the Fed was championing the concept that, the long and variable lags, they're going to be shorter this time because we have forward guidance, and look how great we've done so far. This is about usually when you start to see cracks from the hiking regime. And this is one part of the market. I emphasize this in the webcast earlier in the year on this. It's been something I'm watching. The good news is it doesn't look as scary as it was when it comes to availability of loans. But if you think about the rate move we've seen, if in the last 8 weeks or so prior to this unfortunate new invasion/war, is you find that having these asset prices go down again, it just renews the nervousness about the banks. And I didn't include the kind of small bank index, the KBW index out there that shows the index performance of the banks. But we are actually today below the levels we saw back in March this year. Yes, we went a little bit lower after that, but we're not back plumbing the highs where we saw this big resurgence post no banks going down for a couple of months. So I think there's going to be some renewed kind of scrutiny on the banks. We'll hear more about this when we get third quarter earnings as well. But I could see some new eyes coming back to these hold to maturity portfolios. So again, I'm not going to harp on that. What I want to do is talk about the inflationary regime, because I think we have set up, and a lot of the pain points we saw in the inflationary environment are indeed behind us. So let's look at that right now. If you follow our work at Doubleline, we like import-export prices to think about what's going on from the inflationary argument. As Mr. Gunlock says, these don't have the hedonic adjustments. You're just looking at here's the price coming in, price going out. And again, it's nominal dollars. And so this allows you to see that there has been some pressure. That uptick you see there, some of that is driven by the recent resurgence in oil prices back in August. So again, looking at this data, it does not augur for this really strong inflationary environment. Another thing I like to look at is prices paid, the manufacturing sector. We were talking about this in strategy meeting today, where one of our PMs was saying, Well, if you want to go find appliances right now, remember that was all the craze 18 months ago. You couldn't find something, you were on massive delay. Now they're 40, 50, 60% off. And part of that is inventory restocking, got to move that inventory out. But notice the prices paid. There are more people that are paying lower prices today than we're paying higher prices today. So this is an input. This leads into the PPI, which sends a lead CPI. So again, this is a positive attribute. Again, it doesn't mean that we're going to see deflation in goods at this stage. But if you look at the good side, which I'll show you in a little bit, you'll see there has been some disinflationary to deflationary pressure. Let's talk about the CPI. And so let's not just look at the U.S. I bring this out every 6 to 12 months to remind everyone that inflation. I know Milton Friedman said it's always a monetary phenomenon, but I like to say that it is a global phenomenon as well. And the only thing that doesn't really look like it's participating, like the other lines here, is that purple line. And the purple line got disconnected back in 19 as well as in 20, and has really been the one that's kind of the aberration to the rest of the world, and that's China. You can see world CPI, you can see developed market CPI, and you can see EMX China CPI, all are running at elevated levels. And that hookup, some of it is because, again, as I said, that spike in energy price that we saw in the last, let's call it 2 months or so. So in general, this idea that the U.S. drove inflation or it's coming from other parts of the world, this is really the fiscal response globally of monetary policy being extremely accommodative, the fiscal response mechanism of throwing money at the problems as well. And we all did it. Plus, we all got hit by the supply chain constraints when we lost one of the biggest producers in the world. So let's come back here to the U.S. Let's look at core inflation here. I mentioned that we have goods. Goods is the gray area. You can't see its contribution. So when I talk about contribution to CPI, this is each of these three pieces. It takes whatever their CPI rate is times their weight in the core CPI to give you that shaded area. And you can see here that from post-GFC, we have infrequently had bouts of goods inflation. However, we primarily had goods deflation. Notice that gray area from late 2012 till roughly, early in the pandemic in 20, or really once we're getting kind of the other side of the pandemic, was deflationary. It was subtracting from inflation. We see the surge there. This is probably why the Fed wanted to say things were transitory. We saw it on the good side, but notice that gray area has effectively disappeared now. It's essentially got a zero contribution to overall CPI. It's the yellow area and the blue area. And I'll focus on the blue area first. Kudos to Jay Powell for coming up with this new idea of super core inflation, which is core services X shelter. I'll get to that. I have another slide on that. But I've used this slide for many years because I like to show people how stable that yellow area is. The housing market has some volatility. Notice how much contribution housing is giving to us today in the shelter component. But notice back in the global financial crisis, how much when real estate went down 40, 50, 60%. I think nationwide it went down around 35%. Notice that it only detracted about 0.5 percentage from CPI in the 2010 experience. And so this is where we talk about shelter runs on a lag. This should roll over a little bit. Yes, we have rent resetting. It probably doesn't decelerate as fast as it accelerated, but in general, you're going to get some pressure downward on this. Look at the trend in inflation. The one thing that is not trending downward is that yellow area. Notice over the last 32 years, the yellow area has always been a positive contributor, whereas the other two parts of the series have not. So focusing on just that area, which Jay Powell calls super core, maybe isn't the best area to focus on for having it. Maybe it is that they want that stability in the rate and they want some level of inflation. Notice that we got some disinflationary pressure during the pandemic. It kind of came back, but it's been relatively stable. So this next slide breaks out supercore and shows you here's supercore, whether you use the weights in CPI or whether you use the weights in PCE. And effectively, it gives you a level of inflation that is beyond comfort. This is beyond the Fed's comfort zone, right? They're used to this measure being in that's called the 1.5% to 2.5% range. They can live with that, especially in PCE. Most of the time, it hovers around closer to 2%. But notice this tick up. And to me, by focusing on this component, it's one way to say inflation's too high. It sounds great to call it this super core idea. It sounds like it's super important, right? We throw the word super in front of it. And look, it gives me the ability to say it's above our level and I can hike as much as I need to. Now, granted, the Fed doesn't need a reason to hike. They can do what they want to do. But in general, this is a measure that's out there. Now, what does super core measure? Well, it only gets rid of three key things: energy, food, and housing. Or as I call it, the inverted Maslow's hierarchy. Only those three things we need to live, right? Or at least live a decent life is to have those three things. If you strip those out, that's what super core is. And so it's things like leisure, it's things like services on the food sector, when dining out, because that's different from food stuff. So it is this area. It also includes Medicare, medical bills, educational side. So these tend to be pretty stable and kind of stickier things. So the idea that the Fed is focused on this, it causes me a little bit of pause, but this also tells me that maybe what you'll find is that the Fed stays too high for too long because they're looking at the wrong measure. Again, I'm not here to rationalize Fed policy. I don't see Fed cuts anytime in the near term coming. They probably come some point in 2024. But we're going to have to see a degradation of the data set to get there. I'm bringing this up because I get so many questions on super core any day, but to me, it's a pretty worthless measure. Moving along, the unemployment rate, this is what the key to watch. Whenever unemployment goes above its 12-month moving average, you should get on watch. Whenever it crosses its 36-month moving average, we've always had a recession, which makes sense, right? When the unemployment rate goes up, people are losing jobs, you lose jobs, less money to go around in the system, and it causes some problems. This is not concerning at this level. Today, looking at it, yes, we've crossed the average. We should be on watch, continue to watch this, but effectively, it really hasn't done a lot for the overall economy. And some of that is because we have job openings. There's jobs out there. They may not be the exact job you want. You compare it to the labor force. Look at that bottom line. We take the ratio of the jobs available to the JOLT survey, or the JOLT survey, I guess I should call it, and you compare that to the people that are looking for work. And you can see that ratio hit 2 jobs available for every person looking for work back kind of in peak early 2022. We're down to about 1.5 now. So although there was this improvement in job openings last week, we also saw the improvement in some of the amount of people looking for more work. That's been a higher participation rate out there. So you have this imbalance. That's another reason the Fed has been focused on keeping these higher for longer. But the good news is, at least to employers, is that the wage growth is decelerating. Not great for workers as well, where workers were getting some of the best raises they've seen, or best increase in compensation they've seen. But what you see is that Jay Powell has been out there saying that the level of wage growth we have out there is not consistent with 2% inflation. I don't know what level of wage growth is consistent there, but that's
that. So back to wage growth, we talked about the consistency there. The savings rate has diminished. So we saw the big spike in savings rates. This was due to a lot of the stimulus that came through. We hear about this concept of excess savings that was helping drive growth here. But now people are back to savings rates that are really consistent with kind of the more bullish scenarios, right? Look at when you had savings rates in these levels, that was kind of in the aughts when everyone was buying housing, spending money, driving the economy. The savings rates are below those kind of pre-pandemic levels. And so, again, it's not that concerning, but it's not something that's a strong positive. What's also not a strong positive is the explosion of the U.S. budget deficit. And so this is something that's been on people's minds as of late. When you think about what's happened here, look at that. We had the response mechanism during the pandemic. Obviously, it was a big crisis. It looked like we're starting to recover. Now, all of a sudden, look at what we're doing. We're expanding the deficit at 7% of GDP right now. 7% of GDP to grow. And again, these are nominal dollars. We're talking about a real growth rate that's estimated to be 2.1%. slap inflation on that, maybe it's 5%, 5.5%. It says that we've essentially borrowed more than we've grown this year. So again, it's a very kind of challenging environment. And just think about what happens if we tip over into another recession. It's going to be quite strong. So there's a big problem with Washington. We all know it's continuing, but at some point, we're going to have to pay the piper one way or the other. Lastly, the Fed was running one of the biggest hedge funds in the world, where they bought assets, they financed at a very low rate. All of a sudden, they've had to change that dynamic. And so there is something that changed. The methodology did change in 2022. And so it's cumulative from that point on. But it's pretty amazing to show how much money that the Fed has lost, right? This is essentially what they have to go back, and they're paying the overnight rates, but their asset pool yields like 2%, 2.5%. So they have this negative arb that continues to erode money. So it was this nice kind of, I'll call it the carry trade that they had for so long. And now because of their rate policy, and again, you can see it's consistent with when they started hiking rates, it's really driven that down. So let's talk about the markets real quick before we jump into the funds. So what's here is 4 different asset class type of volatility measures. The red, green, and black are on the one axis. That's the VIX, the FX vol, as well as high yield credit spreads. And then there's the blue line. The blue line is the MOVE index. And what's important about the MOVE index is that it's bond volatility. So it's the VIX equivalent of the bond market or the rates market. And so notice how elevated volatility has been in rates. Right, you can see that pre-pandemic, we had a volatility level that was probably somewhere between 40 to 60% of today's levels. This is what's happened to the bond market. This is what happens when you get whipsaw behavior back and forth, and it leads to a lack of confidence in markets. If this type of volatility was going on in the equity markets, people would be panicked. You look at the calendar year performance. We've updated this. This is going back all the history of the Bloomberg Ag. And what you see here is that 2023 now is on pace to be the 4th negative year in a row in the bond market. Secondly, we're on a bad trajectory once again after starting off so strong in the first month of the year. And more importantly is that, we're getting to these levels where essentially now yield levels should be enough to help insulate with some of the price moves we're seeing out there. So again, another tough year for traditional U.S. aggregate that has a lot of interest rate sensitivity. Looking at the third quarter, just kind of reviewing it, taking major asset class into account, you can see there's a lot of negative numbers. The negative numbers, when I look at treasuries, agency MBS, CMO, agency CMBS, IG corporates, as well as EMFI sovereigns, those are essentially longer duration asset class. So fixed rate, they have duration. Duration was your enemy in the third quarter. Look at what did well. Floating rate assets, things like risky credit, CLO triple Bs, which we do own a fair amount of in some of the funds that I'm going to cover today. Things that are down in the capital structure in the RMBS markets. And notice here that the non-agency CMBS market, those tend to be a little bit longer duration assets as well. So they didn't benefit that some of the other credit sectors did. So it's a tale of two worlds. This world it's very similar to what we saw back a year ago with the rising in rates, the repricing. But now this is the part of the cycle where, because of this narrative about the U.S. exceptionalism, the risky parts of the credit market have really rallied. And so we don't think it's time to chase those assets. In fact, if anything, some of these you should probably be a little skeptical of those trends continuing. I just had to update the Treasury drawdown chart because we are at new highs in yields. When you start at very low yields, this means you have a meaningful drawdown. Who would have thought back buying a 30-year Treasury with a 1% coupon, we would make you down 53% on a cumulative basis over the next, let's call it 2.5 years, or it's really been 3.5 years at this point. But again, this is what happens when you start at very low yields. I also point this out is that, if we do have a slowdown, I think rates are too high, you get some reversal, you can really make some money in this idea. I don't think we're going to retest the lows that we saw in 2020. Therefore, you're not going to essentially double your performance here. But this allows you to kind of have an asset that if there is some sort of rate rally, really participate. Talking about credit, I said it's been a risky credit rally. So we ranked the credit sectors, and this gives a little more granularity. And you can see here that it's the risky credit, CLO double Bs, triple C bank loans, triple B CLO, single B loans. Notice it is the riskier parts of the market that have been doing well. High yield triple C, the loan market's done quite well this year, almost up 10%. And notice on the right-hand side, what you have is you have the things that have duration and also commercial real estate. And so the triple B tranche of the CMBS is one of the riskier parts of the market. Yes, there's lower rated tranches, but it's the one that has some default risk today as well. And so it continues to reprice. Looking at rates, we took the rates view back to 07 just to show that where we are in the overall cycle right now. It is pretty amazing how much yields have repriced everywhere. And if you look at this, some people are talking about there being, more of an inflation premium higher for longer, but that's not what the break-even market has told us. Yeah, 30-year break-evens have ticked up, maybe about 10, 15 basis point, but this last move in yields has been what we call a real rate rally and or a real rate sell-off. And so what I'm looking at here, this is why you've seen some weakness again in the equity markets, because when you think about the equity market, the PE multiple, it's the inverse of the EP, which is earnings yield, which is comparable to a real yield. And so when real yields go up, it really puts pressure on markets. And notice they were going sideways-ish most of this year. That pressure hit meaningful last year, and you're starting to see a new push upward. So the real yield can be two things. One, it can be growth. That's how most of us think about it. But potentially, it is a term premium. Maybe there is some default premium priced into the market because of these structural deficits. And so time will tell with this, but this is not a higher inflationary regime, or at least that's not how the bond market seems to be responding over the last 2 months. It seems to be that there's this new premium in here on real yields. By the way, having real yields at this level is something that we really haven't seen since the late 90s. And so, yes, there's brief periods in the 06, 07 environment, but in general, to have at these levels, it's pretty strong. You can slap inflation on top of this, and that would be your nominal return going forward. Now, the downside to buying tips is that if you have deflation and you get a negative inflation rate, that actually detracts from the overall yield as well. But right now, looking at this shows me that there is significant value, at least value we haven't seen in the rates market in a long time. This last push up in rates has driven the dollar index up, where it looked like the dollar is really breaking down after getting to almost 115. Earlier this year, it kissed a little bit below 100. I think it was a 99 handle earlier in the year. And look at how it's rebounded meaningfully. This is because the U.S. rate move has been higher. This idea that the market is extracting some of these hikes out of the market. I just don't think the Fed really has the wherewithal, especially with all the conflicts going on, of actually hiking in the market today. Copper gold and the 10-year have been very disconnected. They tend to converge at some point in time. Right now, copper gold is saying that yields should be meaningfully lower, and yields are saying that copper gold should be meaningfully higher. So at this stage, there really isn't too much to note from this chart except extreme divergence. Usually when you get the extreme divergence, they meet. Look at early 2021 with copper gold spiking. You got them to meet. Now we're kind of getting this reversal here that we haven't seen in yield. So time will tell on this. It's been a very reliable indicator on the directionality, and at least the yield market hasn't been listening to copper gold as of late. We all know about the yield curve in recessions. Remember, it's not the inversion that you get worried about a recession. It's actually when you uninvert or the curve steepens, and we've seen some steepener. This is the 10-year to 3-month. The 10s, 2s is even tighter. 10s, 2s got to like 108, 109. We've been hovering in the low 30s at this point. So we have a bear steepener going on in the marketplace over the last 2 months. And it's been something that even though it's a bear steepener versus the bull steepener, you definitely should be on watch for what that means over the near term. And again, yields are higher. Ag is the highest level we've seen in terms of its overall yield since really pre-GFC. And so again, there's value in this side of the equation, looking at bonds to do stuff for your other portfolio. If you want to get more creative than looking at just the ag, These are bar charts. The bars show you what the min and the max and yields have been over the last 10 years. So 10 years ending last Friday. The average, you can see there, the average has been a lot lower than where we are today. Today is the current snapshot, or at least as of Friday. And you can see here that things are in the upper end of their ranges. Things like treasuries, agency mortgages, IG corporates, triple B CMBS are at really 10-year highs today. And so there is some value in owning some of these assets. A little more concerned about the CLO triple B. I do have some concern about the triple B CMBS market, but there are places to take some of that risk. Low quality bonds, everybody focuses on high yield or just loans in aggregate, but look at where the yields are. Even after the performance I showed you, triple C high yield still yields 15. Why is it yield 15? You're probably not going to get 15, right? You're going to have some defaults along the way. These are to no losses. Look at triple C bank loans because they're floating in nature. Again, there's probably a little bit more default risk in some of these names, 16.5%. Again, don't think you get 16%. Look at corporate triple C's and EMFI on the far right-hand side, 16. But you don't have to go there. There's 8s, there's 9s, there's 10s in higher quality assets on this. So what I wanted to really show here was that there are ways of taking credit bets out there that maybe aren't run of the mill. Maybe they're not readily accessible through an ETF. But if you're going to take risk out there in the markets, there is a calculated way of doing so. And another way of thinking about that is the price of the assets. And we've illustrated this earlier in the year, but just look how low some of these bond prices are. And I point this out because if you buy a bond, your best case scenario is that you get par back at maturity. Maybe it's callable, you get 101 or something like that. But in general, par at maturity is what you're looking for. And so if you can buy an asset at 80 cents on the dollar, like EMFI sovereigns, and they don't default on you, there's 20 points of upside there, one. Secondly, if spreads tighten in, there's the ability to trade some of this as well. So prices can indeed go up. You insulate yourself against some losses out there, but more importantly, you give yourself the ability to trade around if need be. So thanks again, everyone. It's into my webcast for the year. I'll talk to you next year on the webcast. And don't forget to catch us on our various podcasts that we put out there. And more importantly, if you want to watch this stuff, go to the youtube.com/Doubleline Capital. Thanks again, and take care, everyone.